Hello everyone. So I think we should begin the session. So a very good evening to everybody. Today we will be talking about something that's been a very fancied word, and given that a lot of people read about the market and make a lot of money. Yes, we will be talking about equity shares today. So today's session will be about what are really equity shares, and I'm going to focus on the types of equity shares and maybe talk about a little bit about the preference shares and ADRs and GDRs. And then we move on to, understanding the capital market as such. So, as you are all aware, and there is a lot of talk about how the markets are doing, and there's a lot of money that gets made every day. So, what are really equity shares? So let's just understand in the first place that when a company decides to raise capital, it basically wants to raise the capital through either taking a loan or getting people to be their partners. If I were to raise money for a business, either I can take money from you as loan, or I tell you, let's be partners, and we will share the profits and the losses. Partners, what I'm basically talking about is equity shares. So equity shares are nothing but the ordinary share capital, or also called as common stock. And equities represent ownership in the company to the extent of the shares that you hold. So let's say if a company today, let's take an example of a company like Infosys. And Infosys capital, let's say, and for the sake of example, is let's say $100 million. So what it means is that the $100 million capital, or and I can probably put rupees to that, saying 100 million rupees is the capital. It is divided into 10 million shares of 10 each. So this part of the entire capital, the equity share, the share as we understand from a dictionary meaning, is a part of that particular capital. So the equity share represents a part ownership in the company. When you own shares of a company, you are the owner of the company to the extent of the money that you have invested. The company can the company can issue shares by way of ordinary shares or preference shares. We will talk about preference shares as we go along. But focusing again on the equity stock, call it shares, call it stock, which all means the same thing. When you own a stock or a share, it represents a claim on the company's asset. The very reason why you became a shareholder is because you would like to share the losses and the profits in a company. Now, when we talk about equity shares, and as I mentioned, you own the company to the extent of the shares that you hold, which means the capital is an owned capital. On the contrary, if the company would have raised the capital by way of a loan, then that capital would be a borrowed capital. The question is, why would you invest in shares? Let's take an example. If I were to ask for a loan of, let's say, 100,000 rupees, the lender would want to know what is the interest I pay on this loan, and also when will I be returning this money to the lender. Similarly, if I talk about the equity shares, the return is going to be by way of profits here. So if the company makes profit, the profit will be distributed in the form of dividends. So dividends are nothing but distributable profit. Also, the company will not be returning the capital, but will allow trading in these shares. So if, going by the earlier example, on a capital of, let's say, 100 million rupees, if the business is doing well and we make 100 million profit on a share capital of 100 million, I'm just taking a simple example here to prove that basically the 10 rupee share should now become 20. So the reason why I invest in equity shares is to expect that the prices or the value of that 10 rupee share will go up in future based on the company's profits. So if a 10 rupee share will be valued at 20, effectively I have doubled my money. And this is nothing but capital appreciation. In a loan, you are sure that you are going to get an X percentage as interest. But in the case of equities, what you make money is through either the distributable profit or the capital appreciation. Please note that the dividend is a discretion. It's the discretion of the management whether to declare dividends or not. Dividends are not compulsory. Now, when we talk about the value of the shares increasing or going up, where and how will we realize this profit? The value of the shares goes up and is traded at a higher price only if there is a market for it. The 10 rupee share will be valued at 20 based on the company's profits. But to realize this 20 rupees, the shares need to be sold and bought by somebody else. This means that the shares have to be transferable. The shares are listed on a stock exchange, which means they are basically allowed for trading, which means anybody as a shareholder can sell the shares, and on the other side, a person willing to invest or wanting to buy the shares can do so. So that's our next point basically, that the shares are freely bought and sold. Now let's also take another example, that the company raised capital by way of equity shares. People invested in the company. The company carries on the business for some years. And after some years, for maybe expansion or any other reason, wants to raise additional capital. So it probably wants to have more offices or get into another business or expand basically, and hence needs more capital. Given the fact that the shareholders of the company, the existing shareholders of the company, laid their trust in the company and invested, it makes sense to reach out to the existing shareholders and give them the first right to apply for additional shares. Also, from a company's perspective, they already have shareholders whom they can reach out to for additional capital. Having said that, it is also important at what price is the additional capital raised at. So the additional shares, we will call it a rights issue, should be at a discount. Let's take the same example. The 10 rupee share is valued at 20. If I would like to raise additional capital by a rights issue, I should offer it at maybe 17 or 18 to make it a profitable proposition for the existing shareholder. It doesn't make sense for anybody to buy the shares at 20 when they can do so in the open market. So that's our next point basically, that the rights issue has to be at a discount to the market price. Now let's take one more step ahead. The company, for instance, makes huge profits and would like to share this profit with the shareholders. Now we've already understood that when the profit is distributed by way of cash or stock, we will call it as dividend. But company having accumulated the profits over the years, and this accumulation is by way of reserves. So here, the company chooses to capitalize the reserve. Let me explain that. The reserves will be now treated as capital, and reserves will go down and capital will go up. So capitalization of reserves is nothing but the bonus issue. In simple terms, bonus shares are free shares. The company would like to reward the shareholders by giving them free shares. Now, if I give away as a company free shares to my shareholders, the share capital is going to go up, but no money is going to come in. So where do I get the money from? I will get the money from the already accumulated reserves. So what I'm effectively doing is capitalization of the reserve, which is nothing but the bonus shares. Of late you would have heard that HCL Technology has issued or has declared a bonus issue. They will be giving one additional share for every share that you hold, a 1:1 bonus. Same goes for Tech Mahindra as well. So these are the features of equity shares. Let's focus now a little bit on the capital structure again. When a company starts its business, it has to declare its authorized share capital. Authorized share capital is nothing but the maximum share capital that the company can raise through shares. This number is registered with the registrar of companies as to the amount or capital that the company can raise as share capital. For example, and here I'm going to take an example so that we understand all the other types of share capital as well. Let's say the company starts off its business with an authorized share capital of 100 million. This is the number that is registered with the Registrar of Companies, and that's the maximum that the company can raise. Having declared the authorized capital, the company goes for a public issue, offers these shares to the public, and wants the public to invest in. So the company, let's say, out of the 100 million, is offering, let's say, 80 million rupees as share capital, effectively saying 8 million shares of 10 each. I'm just keeping it simple out here. So when the public subscribes to these shares, the subscription amount, the capital that is subscribed for, will be called as the subscribed capital. Basically, the interest that is generated and shown by the public in buying the shares. If the issue is entirely subscribed, we will say that the issue of 80 million is fully subscribed. At most times, it's oversubscribed as well, and in bad times, partially subscribed as well. Against this 80 million capital, the company is issuing as many shares of 10 each. This will then constitute the issued capital. So the company will issue these shares, 8 million shares into 10 each to the applicants. So out of the authorized capital of 100 million, 80 million becomes the issued capital. Now, I have taken an example here that each share is 10 rupees. So what we are looking here is to issue 8 million shares at 10 each. Now, does the company have to call or ask for the entire 10 rupees at one go? The answer is no. The company can choose to ask for these 10 rupees in a staggered manner or in parts. The company may call for 5 rupees at the time of issue and 5 at a later date. So the amount that is called up, so out of the 80 million, the 8 million shares, if 5 rupees is called, then 40 million will be the called up capital. So it's still the 8 million shares of 10 each, but the entire 10 rupees is not called and only 5 rupees is called. So 40 million will become the called capital. However, the entire money may not be paid by the public. Some of the called capital may not be paid. So out of 40 million, if let's say 38 million is paid up by the the public, that would constitute the paid up capital. So paid up capital is nothing but the called up capital minus the arrears or the unpaid amount by the shareholder. Now let's talk about what are the advantages of investing in equity shares. As we've already mentioned, dividend is the first and foremost advantage. What you get by way of return is the distributable profit. But the bigger advantage and the reason for investment in equities is capital appreciation. We've already spent some time talking about it, that the 10 rupee share can become 20 or so, which is nothing but your capital appreciates. The third one is the limited liability, which means that in case of losses or in case of bankruptcy, the company chooses to close down its operation. The liability of the shareholder is only to the extent of the amount of the face value. So your liability is restricted to the extent of the amount that you're supposed to pay. This would not be the case in case of a proprietary firm or a partnership firm, where the liability is unlimited and the shareholders or the partners or the proprietor's personal property can also be taken away. So this is an advantage as far as equity ownership is concerned. The liability is limited. And we've already talked about the ownership rights, that you own the company to the extent of the shares that you hold, and you get the first right in case the company wishes to raise further capital. Bonus shares or free shares is another advantage. If the company chooses to reward its shareholder by free shares, then that's another advantage. Let's also talk about the disadvantages. As I had mentioned, dividends are discretionary. So there is no fixed return as such. The company may choose not to declare any dividend for years, and the profits may be plowed back into business. So from a return perspective, dividends are not fixed, hence a bit of a disadvantage there. Fluctuation in prices. The price or the value of the stock keeps changing. Given that the stock or the shares are traded, the day-to-day demand and supply will cause a fluctuation in the prices. Which means that if you invest in a particular share at a particular price, there is a likelihood that the stock price or the share price may go down the next day. The third disadvantage is the control. Having said that you own the company to the extent of the shares that you hold, the control, however, is very limited, given that the ownership is very limited, a very minuscule percentage from a retail investor perspective. A small investor will not have any control or any say in the management of the company. This again is one of the disadvantages. Now let's talk about another type of shares here. Preference shares. When we talked about the features, we said that the dividend is not fixed. Here's where we come up with a type of share where the dividend is also fixed. But the word preference suggests not just about fixed dividend, but preference. Preference in terms of preferential rights with regards to payment of dividend and repayment if the company goes bankrupt or files for liquidation. So preference shares are basically shares who have a preferential right with regard to the payment of dividend and repayment of capital in case the company is winding up. Let's talk about the difference between the two. As I have already mentioned, equity shares get the payment of dividend after the preference shareholders are paid. The rate of dividend is decided, it's discretionary, and in the case of preference shares, it's obviously fixed. Equity shares cannot be converted into preference shares, so you do not really have the option to move your equity shares into preference shares. Preference shares, however, And here again, a particular type of preference shares have that option, which is nothing but convertible preference shares. On the other hand, equity shareholders have voting rights, which means they do have a say to the extent of casting a vote whether they are for or against a particular decision that the management chooses to take. Preference shares do not have any voting rights. However, they do have voting rights in matters which are concerning their interest. So their voting rights are limited to only matters concerning their interest. That's about it. And finally, when it comes to the bankruptcy or liquidation, equity shareholders are paid after the preference shareholders. And preference shareholders, obviously, and as the word suggests, get a preference over the equity shareholders. Let's talk about the type of preference shares. So what I've listed here is basically 4 types, and I'm going to elaborate that in terms of each of these, what do they mean, by way of the next slide. So here is where we talk about all the 4 types. Cumulative preference shares. Here, if in a particular year, if the preference shares have not been paid dividends, they can actually get it, and they get the past dividends in case there has been a miss in the past years. So that's only in the case of cumulative preference shares. Of course, the non-cumulative preferred shares will not have any such benefit, and they will miss the dividends and they will not get paid at a later date. Convertible preferred shares, as we spoke about, have the right to convert the preference shares into equity shares, and they can get into ordinary shares at a predetermined price on a pre-agreed date. So that's the right that they get. Redeemable. A redeemable preferred share has a maturity date, which means that on a particular date, they will get the amount of capital that they've invested in the preferred share. And as far as the 4th type is concerned, which is nothing but participating preferred shares. Participating preferred shares have, as the word suggests, a participation in the profits of the company. So if the profits are very high, the dividend that they get will also be higher. So this is like a fixed part, but that can change, and you can get a higher dividend or a higher return in case the company makes bumper profits or extraordinary profits. Let's move on to understand another type within equity shares, very popular, is the American depository receipts. Let's talk about depository receipts first. Let's take an example here first. If a company chooses to raise capital outside the country of registration or the domicile, it has to go to another market to raise capital. It can do so by not issuing directly the shares, but a receipt, a depository receipt, which represents ownership in these shares. Let me explain this with an example. If HDFC Bank, you would have heard, has come out with an ADR issue. So what HDFC Bank is looking to do is to raise capital in the United States, but it can't directly issue shares to the US citizens. And the US citizens cannot directly invest in HDFC Bank, given the regulations and control going to a foreign owner. So what happens is that the company will issue shares to a depository in the United States, and the depository will in turn issue a receipt which is representing ownership in the shares of HDFC. So what we are saying is that the direct issuance of shares does not take place, but the shares are issued to a depository in US, who in turn will issue a receipt representing these shares. Since this is done in the United States, we will call this as American Depository Receipt. Now generally, 2 shares equals to 1 ADR. And the ADR is denominated in US dollars. Also, to facilitate trading, the ADRs are listed on the American exchanges like a New York Stock Exchange and so on. Also, in case the company declares dividend, the dividend also will have to be paid in US dollars. Now, if I were to talk about the advantages, well, that's clearly an advantage by gaining access to a foreign market. Builds a lot of reputation for the company, and it's a lot of reliability as far as the share prices are concerned. Also, there are some disadvantages. The entire issue of ADR could be a costly proposition because there is a depository in between, and they would also be charging for the same. The prices could be different for institutional investors or retail investors. And given the fact that the overseas ADR issue or American Depository Receipt issue would be very limited number of ADRs will be issued, that will cause an illiquid situation on the ADR market. Not many ADRs are traded. That can cause the prices to be very volatile, given that there are not many ADRs floating and being traded on a day-to-day basis. Of course, multiple listing, given that the shares are listed in the domestic exchange, ADRs listed on the American exchanges, also will result into price differences across market. We've talked about the American Depository Receipt because the depository receipt or the share capital is issued to an American depository and the capital is raised in the American market. What if the share capital was raised elsewhere? If it's outside of US, if it's not in US and elsewhere, anywhere in the world, we will call that as global depository receipts. Very similar to what ADRs are. It's just that the American depository receipts are raised in the American markets and global depository receipts would be elsewhere. So what we've learned now is equity shares are issued in the primary market. Primary market basically means the first time issuance of shares to the general public. Now the issue could be not a public one, but the company can choose to approach some private investors, limited number of investors, and choose to offer them the shares. In that case, it would be called as a private placement. And if the company chooses to come out with an offer for the general public, we will call that as a public offer or a public issue. The same will then have to be listed on the stock exchange for the day-to-day trading. Yeah. Public issues are handled by investment banks. So a company will reach out to an investment bank and ask them to manage the IPO or the initial public offering for them. On the other hand, private placement will be selling the securities directly to the investors. The investment banks may have a role to play here. In most cases, they would also manage the issue and be an intermediary from the company side and the private investor side. So the capital market is basically the primary market and the secondary market. Let me explain that. The first time issuance will always be referred as the primary market. So a company comes up with a public issue, public will approach the company, apply for the shares, get the shares allotted. And when the investors will sell their equity shares to another equity share holder, another investor, that would be a secondary market. So the public issue is nothing but the primary market, and all the subsequent trading that will happen, and investors will sell and new investors will buy, will be termed as the secondary market. Secondary market could be for equity as well as for the debt, just like it can be in the case of primary market as well. So a company can come out with an equity issue or a debt issue as a primary market offering and can subsequently have a secondary market where the equity shares or the debt securities are traded. So in terms of the difference, the basic difference is the first time issuance is what we will call as the primary market, whereas the subsequent trading is the secondary market. IPO is the feature of a primary market, whereas the secondary market is the subsequent trading in the debt or equity market. Let's just summarize our learning. So we spoke about what are really equity shares. We focused a lot on the features of equity shares and what are the various components of a capital. We also looked at the types of equity shares, where we looked at the ordinary shares, the preference shares, the rights shares, and the bonus issues. We also talked about the return on equities, dividend being the return on equities, and mind you, dividends are discretionary. But the basic reason for which people invest in equities is capital appreciation. ADRs and GDRs are nothing but depository receipts which represent the ownership in the shares. We then examined the primary market, which is nothing but the first time issuance, and compared the same with the secondary market based on the trade in those securities. So that ends my session on basics of equities. I'm open to questions if you have any. You can either ask me a question directly or you can write on the chat. I'm more than happy to take any questions now. Yes, so we have a question here. Why does company issue bonus shares? A couple of reasons. First and foremost is the company is rewarding the shareholders with free shares. Now let me also make it a point here that if I hold a share which is, let's say, valued at 2,800 and there is a free share which I get, the share of 2,800 will now become a 1,400 rupee share. So as such, the value does not change. But what it does is it increases the liquidity of these shares. Plus, of course, the number of shares that are in the market, floating in the market, and a good reputation that the company is rewarding its shareholders in doing that. But basically, bonus shares are nothing but capitalization of reserves. I also have another question, which is preference shares, the difference between preference shares and preferred shares. Basically, yes, that's more or less the same. I'm waiting for more questions. Well, looks like we don't have any more questions. Oh yes, there is one. Is there an eligibility for ADR, GDR? If you're talking about eligibility in terms of which company can issue ADRs or GDRs, the answer is yes. Clearly, the regulators have listed down the eligibility criteria of which company can raise capital in foreign markets. So there is a whole lot of list which talks about the eligibility. You can go to any of the websites of SEBI if you would like to know more on how. Or maybe what I can do is I can send you the list if you give me the email address, and I can send you an entire list. Another question I have here is, can a single shareholder raise GDR if he is holding maximum number of shares? Okay, let me just turn it around a little bit to say that if a depository or a bank, they can raise or rather issue GDRs, but those will be called as unsponsored GDRs. Let me just elaborate this to explain better. A company, if it's backing the issue of depository receipts and wants a depository bank to manage this for them and get them to issue depository receipts, it would be called as a sponsored issue or a sponsored GDR. In case it's not, and I think that's what the question is presented here, is the shareholder raising GDR without the company's sponsorship on it. We will call that as unsponsored, but mind you, there are regulations around there. So if those criteria are met, then the short answer could be yes, but subject to the conditions or the terms and conditions fulfilled. Thank you, Rohil, for your Gmail address. I will definitely send you across the eligibility as far as the ADR, GDR is concerned. I have one more question, which is, what is the role of investment banks in raising capital? Well, investment banks help organizations raise capital. So let's take an example. If Flipkart, let's say, wants to go public and wants to raise capital, it will have to approach an investment bank who can help them do so. or let's say another popular example and one of the most successful public offer was that of Alibaba or Facebook. So let's say Facebook approached investment banks in 2012 because they wanted to raise capital. They wanted to raise about $16 billion. So they approached Morgan Stanley, Goldman Sachs, and JP Morgan. So these three banks played a very, very vital role and raised $16 billion for Facebook. So investment banks, that's the basic role of an investment bank, is to help organizations raise capital. I have one more question, which is, will company ask for the return if such shareholders earn benefit after issuance of GDR? I think you're talking about the unsponsored GDR that we spoke about. The company will not be it will not be asking for any returns or so. That's purely an issuance So